We have several significant news about Tesla that just happened over the weekend. Not just one, two, or three, but four stories. First, Giga Berlin announced they've reached the ability to build 6,000 Model Ys per week. Next up will be the 10,000 per week soon. This is big news for the reduction of cost of goods, leading to better margins. Next, we have price cuts for Model Y in Canada, followed by a price increase for the Model 3 long range here in the US. In addition to all this, Tesla also announced that you can transfer full self-driving in the US, Canada, and Mexico if you buy a new Tesla Model X or Y by the end of this March. And that's not all. It now seems that you can also transfer free lifetime supercharging if you have that to a new vehicle purchase also. So we've got Jeff Lutz with us, and he's ex-chief quality officer and ex-supply chain executive at Fortune 50 companies. Welcome, Jeff. Appreciate you joining me.
Hey, great to be with you, Herbert.
So all of these news is something that you're actually perfect to answer. First of all, the scaling of the ability for a Gigafactory to produce more cars. What does that do to cost of goods? And then all these price changes that we're going to talk about. What's happening to inventory that some people are saying. Love to get your opinion on that. So let's get started with this first of all. So big news here in Gigafactory Berlin announced this, that it looks like Giga Berlin has reached the 6,000 Model Ys per week. And then they say, now it's on to 10,000 per week. Go Berlin, go. And, they like to do this. They show off their team. It looks like a small team, actually, that point for this. But yeah, comments on this achievement.
Yeah, they may have done this. It's a great achievement. And they may have done this right before they had to deal with this Red Sea shutdown that occurred, this inbound supply issue with the Red Sea and so forth. So what this means for COGS, they have to come out of the shutdown. They've got to re-ramp and get the run rate up. It looks like they want to take the run rate up in Berlin, which is good news. If you look at what happened to COGS for Tesla, if you look at Model 3 and Y, as soon as Austin and Berlin were turned on at very low utilization rates in April of 2022, you saw in that quarter that COGS took a significant hit, like a 10% hit in that quarter. And that's what happens when you turn on these factories with large fixed capital investments and very low output, very low utilization. So what's been happening is you kind of visualize this filling under a curve that's been occurring as they get the run rate of each of these factories up and they get the efficiencies of these factories up. And that's what's happening here. So I think, Q1 is going to be choppy when you have to deal with a supply driven shutdown. That is not good from a COGS perspective. However, the fact that they're getting to this run rate of 6K is, for on a go forward basis, really good for COGS. So, I expect to see continued improvement, in Berlin COGS. And quite frankly, again, the Gigafactories that are not running at full utilization are a fairly significant drag on COGS. People should understand that. And until they get to that full utilization point, Tesla hasn't reached their full potential on COGS, from the Gigafactory perspective. And Gigafactories will always be in this continual cost reduction process innovation. What processes, what station times can we reduce? What efficiencies can we improve upon? Are there consumables that we can get out of the factories? They'll be in a continuous mode of driving COGS down. But again, I view this milestone of getting to 6K as they're getting the run rate of the factory up. They're getting the labor in. They've got the capital in to do this. And it looks like we had a pretty good start in January in Europe from a sales perspective as well. So hopefully all this aligns. They get through the supply issue, and it's off and up and to the right for Berlin.
And you've been very consistent explaining how you see cost of goods going down, therefore margins either stabilizing or even maybe going up again. It's interesting that many people and analysts who are not, as knowledgeable as you, they just automatically think that margins are going to continue to be depressed this year. And one of the things is they think that cost of goods has already been kind of, they've already cut. How much more can they cut? But I think they're forgetting that scaling of the Gigafactories is one of the easier ways to cut scale, to get scale is not, and they're forgetting about that because Giga Berlin, Giga Texas are still very much in scale mode.
Yeah. Watch the Gigafactories, watch inbound commodity cost, and listen to what the practitioners on the calls are talking about. You heard one of the supply chain leaders talk about inbound logistics and the reuse of packaging and being able to instead of just receiving product, unpacking it, and throwing it away, being able to
Mm.
reuse that. All that equates to say these are new things that the Tesla wasn't doing the quarter before, for example. And then listen to the engineering leads talk about their list of things they want to go after, whether it's combining two parts together, reducing a process, reducing a spec, or improving the way a part runs at a supplier. All these things are it's a continual thing that companies do. They don't stop. When companies stop doing those activities is when the volumes are on a clear not only trajectory, but actually they're honestly approaching zero, because then your actions have very little impact to the
Mm.
bottom line of the company. But when you're
Yeah.
building the number one volume vehicle in the world,
Mm.
you have maximum leverage with suppliers. That means you've got two suppliers, maybe three suppliers in every part, and there's a fourth and a fifth that are trying to get in and get that business and come in with a better solution. And then the first two are battling each other for market share. The third so that all that continues when you've got the number one volume car. So yeah, the COGS efficiency in the factories will continue. Watch PPIs in China and the U.S. Watch inbound commodity costs, the BCOE index. There's a bunch of different index for commodities. Watch that. Listen to what Drew, Lars, Karn, and Roshan talk about these event-driven tasks that they're doing. I just gave you a couple of examples. And again, you do that. Model Y is the car you do that on because it has
Mhm.
all the volume. And then these newer vehicles, Model 3, and we're going to talk about a price increase in a minute, but I believe that they've been able to come up the ramp curve pretty quickly on that and then take that COGS burden down. So that if you think about Q4 and they had sequential improved gross margins, that was a quarter that the Model 3 was ramping in, brand new product. Okay, not at its full run rate. That was a quarter where 25,000 S and X were sold. And if you look in significant production, and if you look at that, those are massive headwinds to COGS. The other thing that was a massive headwind to COGS in Q4 is all the shutdowns occurred around the month of September, some point through the month of September. And when those shutdowns commence, the factory doesn't turn on at peak run rate. The factory's got to go tick, 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 tick up and ramp its way up through October. And that would have been true for Austin for sure. And then whenever the Fremont shutdowns occurred, point is there were a fair number of headwinds in Q4, and they had sequentially improved gross margins, and they printed 350 basis points or 3.5% COGS reductions, which is almost double what they normally did for the prior 4 quarters. So I think it's important to take all of these things in context together.
And that's per quarter. Okay, thank you so much, Jeff. I was laughing, smiling because I just love what you're teaching me and teaching us here. Just a lot of good info. Okay, so next we want to talk about all the movements that's happened this weekend. There was price cuts, there was price increases, which I'll share soon, and then there was even this FSD and supercharger. Just comment on what's going on. There's some people who think, "Oh my God, demand must have fallen." What's your quick summary of what you saw this weekend?
Yeah, it's a mixture of things. One is these are very small movements in pricing, and what's interesting is I've talked about the Pavlovian response to price cuts, no matter what the price cut is. So in the Canada one was 4,000 Canadian dollars, which is what 3,000 US dollars on 1% of the aggregate volume in the quarter. And when you start, ticking through all the math on that, I just told you they printed 350 basis points of cost reductions in the prior quarter. And I think the Canada price increase was somewhere between 4 to 6 basis points of MSRP, decline. So we're talking about 4 to 6 basis points, and you have 300. You're doing an average of about 200 basis points of COGS reductions. And here, when you analyze the Canada price reduction, it turns out to be something on the order of 4 to 6 basis points. And this is why I think there's a bit of a credibility issue with how the reaction to these price changes are. I know people don't like seeing all the different activity. Part of the reason with Tesla is everything's transparent. Their prices are on a website. You go to www.tesla.com and everything is just there. I don't know. Maybe Rivian does that. I'm not even sure they're even putting their pricing up there, but no other conventional auto company does that. And then, so that was Canada. And then over the weekend, I guess the Model 3 long range in the US, which is a significant, volume SKU. Remember, Model 3 in global aggregate is on the order of 25%. The old Model 3, the new Model 3 may even run hotter. We don't know yet, but it's around 1 in 4 Teslas sold is a Model 3. And it's, and the two most popular, regions, US is a very popular region for that. So there's $1,000 price increase. Again, these are very small movements in price. And normally when you're an OEM, and I put myself back in the shoes of like, why would I raise price? I just launched the vehicle 3.5 weeks ago. I literally just went out to the world and said, it's this car, it's this vehicle, it's these specs, it's available on this date, and it's this cost. Why would I raise price 3.5 weeks later? Reason I would raise prices 3.5 weeks later, the number one reason is I have an inbound order book load that is higher than I anticipated, and I want to dampen that. That is the message to the marketplace. The second, and I would say a more distant reason would be is I have a long-term supply issue that I discovered. There's a part I cannot get for many, many weeks, if not months, usually, on the order of measured in months. Or there's a technical issue that put us way behind our ability to build product in the factory. I do not actually believe 2 and 3. I believe there are short-term issues with supply, and that could happen. But I actually don't believe that to be the case. I believe they're turning the factory over in December and January for this production. And, they've got to get the product up a ramp curve. But the reason to change pricing by $1,000 is not because there's some short-term supply issue. What you do is when you encounter that is like, okay, I'm going to go solve that issue. I'm not going to go burden the marketplace with just changing pricing here or there. Again, if it's a longer-term issue where I think it's going to cause my supply-demand imbalance to stay out for a long term, well, then I would change it. But I don't believe that to me, that's a remote possibility. And the reason is the China version ramped pretty flawlessly. They're building, significant number of those in November and December. I want to say on the order of 15 to 20,000 or more per month in those. So I don't view that to be the case. So in summary, on the price increase for Model 3, I view that as number one. They probably have a short-term kind of inbound demand spike. Again, the reviews have been off the charts. The price point's still very compelling. If you do a lease on a Model 3, you can still get and utilize a $7,500 credit. I believe I haven't done this myself, but I believe you don't have the point of sale option. The car's not eligible, but I believe through leasing, there's still an option to do it. So yeah, that's what I believe is happening with the Model 3 in the short term. So when you look at all these moves in aggregate and you step back and take a 5,000-foot view, what is Tesla doing? What Tesla is doing is they're doing short-term movements in pricing, very small, anywhere from, call it 5 to 50 basis points in moves in pricing to make sure product is moving and it's properly incentivized in region. 1. 2, there's supercharging engagements where if you had unlimited supercharging, you could transfer it over. And now with FSD, you can do it. These are things that Tesla, in a very kind of cash neutral way, is leveraging their network, whether it's their charging network or now their software as a service network that they've developed with FSD. And this is where Tesla can incentivize consumers in a very cash neutral approach, very gross margin neutral approach, incentivize them. Yes, is there a hit per device or per product sold? Yeah, of course there is. Because if Tesla were to be able to sell that with a full FSD, that would add $12,000 to the price. But now you're looking at an opportunity cost, and you look at it a completely different way. So I'm not trying to put lipstick on it or not. What Tesla is doing with the charging network and with FSD transfer is they're using more cash neutral methods to incentivize people to buy vehicles. And quite frankly, Q1 is seasonably a softer quarter for many companies. It's just seasonably softer. So I don't think there's any issue with doing this. And I think using these methods, buying down loan rates, these are better ways to manage consumer demand, probably. But again, I'm not in Tesla. Tesla sees a lot more data than any of us on Twitter do, so I'm not in their position. I don't know their channel inventory. Nobody outside of Twitter knows their channel inventory with any precision. We don't know their inventory inside of their factories. We don't know their build plan. We don't know what they've built for the last week or two in their factories. So there's a lot of unknowns that when you're sitting outside of Twitter, where there's things that we can assume. And what you try to do is you try to put a lens on things and say, all right, if I was in their position, this is probably what's happening. And these are the logical conclusions. But, in summary, small movements in price up and down, manage supply demand, and then on the supercharging network and on FSD transfer, they're really leveraging their fixed assets and what they've really grown as a competitive advantage over their peers.
Nice. Okay. Yeah. Put everything in context, because most of us and some of the top analysts, in fact, they just jump and say, oh, price cuts. And then they just cut their earnings for the future when they haven't calculated the differences. Thank you for putting that in context.
Well, just one more example on that, Herbert, is the people that were cutting, like, for example, their Model 3 in perpetuity and saying it was in the middle part of last year all the way through whatever, September, and just like, okay, I'm going to cut my earnings through 2030. And then Tesla releases a vehicle that costs more than what they had in their so why, I don't understand, why would you do that in perpetuity, knowing that they're coming out with a vehicle, with a new vehicle where new products, you stabilize MSRP. And in fact, Tesla actually raised the MSRP of the new Model 3 versus the prior. So it's honestly, when you have your own model, you kind of do whatever you want to do in context with your own model, but there's not one way to do these things, is what I would say in conclusion. And there could be better or different ways to look at these things.
Okay, let's go through the actual news that happened this weekend. You got Tesla slashing, they call that slashing, of course, Model Y prices in Canada, boosting rebate eligibility to $12,000 in Quebec. So this is a big deal for Quebec people. So they made price cuts on the Model Y, reducing the price by $4,000 Canadian. Most importantly, this means the Model Y long range now qualifies for a combined $12,000 in rebates if you live in Quebec. I mean, it makes sense why they did this. That could be one of the big reasons. So the Model Y rear-wheel drive and the all long-range variants both saw the price reductions. The price of the performance variant stayed the same. So now you can buy a Model Y rear-wheel drive at $53,990, down $4,000 from the previous starting. At the same time, the Model Y long range has been reduced $4,000, starting at $63,990.
Yeah, and one thing question I have, Herbert, I don't know, and I'm not asking you, but do we even know where these Model Ys are coming from? Mm-hmm. And the reason I asked is last year that there were inbound shipments from China into Canada, and we don't even know where the Model Y that's built in. I'm not saying that these are built in China. I'm just saying that there's a significant difference in the COG structure of a Model Y built in China versus in the U.S. I don't think that's a factor here. This is $3,000 Canadian on 1% of the volume in the quarter. It's literally single digit BPS or 0.0 5 to 6% of MSRP when they're doing anywhere from 200 basis points to 350 basis points in a quarter. But it's just a thought that came to mind.
Yeah, that's a good point. Yeah. Okay. So then, because if it was from China, then it actually could even be just because the margins have improved, cost of goods improved, and then they just do that. makes sense. Tesla has increased the price of the Model 3 long range by $1,000, $46,990. This is the Model 3. Then the other thing that they did was they officially allowed free FSD transfers in the US, Canada, and Mexico if you take delivery of a new Tesla Model S, X, or Y by March 31st. And I think that he clarified, Sawyer, that you can just buy a new car. And if you do, they will automatically just transfer it from your old car. You don't have to sell your old car. The Model 3 now qualifies for the free lifetime supercharging transfer and FSD transfer as well. So if you buy the Model 3, you can do that as well, including the supercharging transfer. This is the agreement for the FSD transfer. You'll see after you place the order. I'm not going to go and read this, but I'll point it out.
I did it. I did it on my Model X last year. Very seamless process. Tesla did a great job on it.
Yeah. Okay. So this is Omar, and he's talking about, how do you take advantage of the FSD? I mean, you're pricing at $12,000. There's going to be a maximum number of people that will like to do that, the uptake of that. He's saying he's glad to save Tesla. One, announced to customers that due to recent economic headwinds, FSD package price is being lowered to $5,000. So he's saying take it from $12,000, lower it to price $5,000, and then announce the availability of new package. FSD would transfer for $10,000. So instead of the normal ones, have to see that, but if you do 10,000, if you want, transferable to another car anytime, that actually makes sense. Cut FSD subscription price to $99 per month, and then you'll be able to do that. Let me just finish this off. That there's also the ability now to transfer free lifetime supercharging. So some people got that, and I don't remember which vehicles when if you receive that, you are so motivated to never sell that car, and it's getting older.
Right.
So what you want to do is if you buy a new one over the weekend and has now made the Model 3 eligible as well, you get to transfer it over as well. What do you think?
Yeah. So back to Holmar's and the proposal, and I was listening to his subscriber spaces. He has it every, I think, Sunday, and another really good idea. So first off, his approach and what you posted there was basically like, how do you get more people into FSD and kind of this, get more people into the tent. And remember, Tesla's developed a software and, they have it deployed. They have the ability to scale it now too. So this is like, how do you get more gross margin dollars into full self-driving? He had another really good idea, again, publicly spoke about it on the spaces about, once you have somebody, is there an ability to convert them to a per mile plan for FSD? So basically, as they engage it and as they use it, because remember, Tesla has your credit card. As soon as you sign up for a Tesla account and say, I'm going to use a Tesla supercharger, and services, like they have your card if you store it with them. And again, that's what you need to do to supercharge. So why wouldn't they use that same infrastructure around full self-driving miles? Because sometimes people buy, I bought full self-driving up front. And it depends how long you keep your vehicles. There's a whole kind of equation around it. Or there's people that go with the monthly plan. But even inside that monthly plan, maybe you're not using it on every drive. So is there something that works better for people where you get more people in the FSD tent and you look at it on a per mile basis, and Tesla comes up with a fair approach to that? And that would maybe more align with robotaxi usage in the future as well when that becomes a reality. But I think FSD now is something that's capable of printing, hundreds of millions, if not, billions of dollars, of revenue to the bottom line, very high gross margins, now. And as the product improves, I think Tesla, first off, naturally the uptake will improve as the product improves. But if Tesla can also be a little bit more innovative on the sell-in side, maybe you can get more people into that FSD tent. And then finally, I just want to go back to the Canada price increase in that story, Herbert. So the other point I wanted to quickly make on that topic was, how do OEMs work when they're launching a new product? And for that product to be announced on January, I think it was 9th, with immediate availability, there was deliveries that occurred within about 2 weeks in the US. There are people posting online that they were taking deliveries of their new Model 3. For all that to occur, all the planning was done, months in advance, because you've got to tell the spring supplier, like, hey, I've got this new Model 3 model. It's coming online. We're going to be in mass production in these starting these dates. I need this much supply from you. Like, all this gets coordinated months in advance. And as you're getting closer to that January 9th launch date, and there's builds that have been happening in the factory prior to that, Tesla makes adjustments to their build plan based on what they're seeing. I have a supply issue. I'm not going to be able to build as much, or I've got too much supply, or looks like the inbound order rate is increasing. Maybe I want to adjust it. The point is these plans are made well in advance, and so for Tesla to change to launch on January 9th, and I think I made this point earlier, but I think it's worth reiterating. For them to launch on January 9th, and then to change their pricing 3.5 weeks later, that's a new issue. And again, it's not a short-term supply issue. You just don't do that. You just keep going and you figure it out, and then you go catch up. Again, I believe there's either a spike in demand or there's a long-term problem. But I think you would have seen the longer-term problem out of Shanghai if there was a long-term issue, because I don't believe there's anything significantly unique between the US version and the China version. I'm sure there are some subtle changes, but anyway, I just want to go back to that point that there's a lot of long-term planning that goes into a launch. And if you do a price change 3 weeks later, an increase, you do a decrease, you're probably dealing with a demand issue, because you're not up your COGS curve. And if you're cutting price, you don't have the right inbound order flow. But if you're actually taking prices up, you probably got more orders than you originally planned for. And the planning window is, 12 to 16 weeks for many of these parts. So the only way to deal with a long-term planning window is a price change. If you have a short-term supply issue, you don't change your price. I just wanted to kind of close on that point one more time.
Yeah, no, thank you so much, Jeff. I mean, you really should have a subscriber ability, because others do, and you're actually the one that knows what's going on with this inventory, price changes, factories, manufacturing, and it just list goes on and on. But thank you, Jeff. Follow him on X at the Jeff Lutz. I mean, this is gold information, more than most people, and they're spreading some illogical fallacies out there, and you're setting the record straight for somebody who knows, or only what you do know. Even you say.
And I don't have any inside information, zero. I'm just, It's more of putting myself, when I see the externally available information, I'm trying to put a lens on it to make some sense. So I hope it's helpful for people.
It is. Thank you, Jeff. Bye-bye.
Thanks, Robert.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.